Oh, you're on mute, Krishna.
Okay, we have number of participants joining, so let's wait for another minute and then we can begin with our webinar. All right. Hello, everyone. Thank you for joining this webinar. Hope everyone is having a great day. So, on behalf of IFOA, we warmly welcome you to today's webinar on the role of actuaries in liquidity risk and credit risk. We are delighted to have with us our esteemed speaker, Arpan Sengupta, a seasoned actuary with extensive experience in various aspects of financial risk, bringing actuarial insights into liquidity and credit domains, which makes today's session very enriching for all of us. All right. So this session is going to be of around 45 to 50 minutes with last 15 to 10 minutes for Q&A. So everyone during the call or at the end of the call, you can put your questions on Q&A box that is below of your right hand side. If you could see, all right. And without further delay, you guys can have a cup of tea or coffee with some biscuits, and let's give mic to Arpan. Please, Arpan, over to you.
Yeah, thanks, Krishna. And I would also like to take this opportunity to thanks IFOA for giving me this opportunity to kind of present on liquidity and credit risk. So yeah, I think I'll just share my screen.
Yeah.
Krishna, if you can let me know if you are able to see my screen.
Yeah, now I can see your screen. Yeah, great.
Okay, so just to give you all a bit of background, how I came to work in liquidity and credit risk, and what are the topics we are kind of going to present here. So as you grow in your actual career, you reach a level where you have to to define your worth to the company, you have to gain revenue for the company. And in my present employer, we are looking at different ways we can leverage our expertise in risk, because actuaries are known for their ability to bifurcate risk and make opportunity out of risk. And then we thought, why not delve into liquidity risk and credit risk rather than other than the insurance risk, which is a upcoming domain, and where we can leverage the knowledge that actuaries already have. Having said that, liquidity and credit risk are slightly different, and that is what we are going to understand. There are areas in which actuaries can work significantly and contribute significantly. However, there are other areas which are already quite rules driven, and where actuaries cannot add that much value, or there is a already a barrier to entry in those fields, right? So these are the topics that we are kind of going to discuss. And in the presentation, in the course of presentation, I'll be stopping at regular intervals. And if you have any question, you can raise your hand, and I think Krishna can take those questions or unmute yourself for you to ask those questions. And of course, as she mentioned, at the end of this presentation, we are supposed to have around 10-15 minutes where you can definitely ask any question. I always expect a lot of questions. There might be areas where you may not agree with me, and that is absolutely fine. Please ask those questions, and please so that I also get to learn in the course of this presentation, as well as if there is a question in which I cannot answer right now. So I'm going to take that question with me, and later on, I can pass on those answer to Krishna or IFO, and I think they can share that answer with you, right? So without any further delay, let us start to this topic, which is related to liquidity risk and credit risk. Now, whenever we talk about liquidity risk and credit risk, this is what I also tell to my team in India, that risk is exactly like energy. Like energy can be changed into, like, you cannot remove energy, like you cannot eliminate energy. It can only be changed from one form to another form. And risk is exactly like that. You try to reduce risk, you increase another risk, right? And risk can only be changed or maybe transferred. And that is what actuaries were doing for last couple of centuries, especially in the insurance domain, where actuaries are very, very well known. So we are taking risk from other people, keeping it with us, and also transferring risk. We are also changing risk in certain other ways. However, in liquidity risk and credit risk, we'll see that sometimes liquidity risk generates credit risk, sometimes credit risk generates liquidity risk. And this, they are just interchangeable, which is something that I want you to remember throughout the course of this presentation. We are going to touch upon multiple areas where this thing happened, right? So the origin of any risk is transaction. If there is no transaction, there is no risk. And be it insurance risk, which is the traditional form of domain where actuaries work, be it liquidity risk, be it credit risk, there has to be a transaction. You must give money to someone else for some risk, to to maybe to handle some risk or pass on some risk, and the other person would take some other measures or some different way to, based on his or her expertise, to kind of handle that risk. And that is where there is a transaction between two parties. And whenever there is a transaction, there arises risk. And that is why I mentioned, once risk is created, it cannot be removed, it cannot be eliminated, it can only be converted from one form to another form. And that will, it depends on your expertise in which form you are more comfortable, and you can play with that form of risk, right? So today we are only going to focus on liquidity risk and credit risk, and maybe uh, point out to the areas of the insurance risk where this how we can tackle insurance risk. That same measure can be probably used in liquidity and credit risk. So this is the first point that I want you to remember, which is without transaction, there is no risk. This is the second point actually. The first point would be the energy, like the conversion of risk. Risk cannot be eliminated, it can only be converted. Second is the transaction. Without transaction, there is no risk, right? So there has to be a transaction for risk to risk to come into picture. And this is the example, like someone lends money to someone else, and the other person is thinking that I'm never going to return the money, right? So the moment that person thinks that he or she is not going to return the money, this creates a liquidity risk, because other person might need that money at later point of time, and you would not have that money, right? So this is a very simplified example of a transaction creating a liquidity risk, right? And you can have number of example. I just chose to give this example because it's very familiar to all of us probably. Now, once that person do not have money, and that person needs money, right? So then that person would approach a bank and try to ask for money, right? Because that person need money. The other person to whom he has lended, that person is not returning the money to him. So in that case, the bank lends money to that person depending on the profile and everything else. And that creates a credit risk for the bank. That is because if the person also do not return back the money, then there is a credit risk. So that is where we can see that transaction create liquidity risk. And the moment one risk is created, it can get transcended into another form of risk, which in this case is credit risk, right? So this is how the cycle of risk moves, right? And we will see that there are other patterns and other ways in which risk can get converted into each other, right? And we'll end this presentation with a method or with a technique where both the liquidity and credit risk are present, and we are also working on and as a company, I work in Moody's, so Moody's also is working on those instruments. Moving forward, so this is the bookish definition of liquidity risk. Now, whenever I understand a topic in actually, I always try to remember this by example, like the example that I started. of course, definitions are important, but I think uh, I struggle to remember definition, but examples are very easy for me to remember. Like the previous example, I'll always remember that. So definition of liquidity risk is the risk that the institution or individual will be unable to meet its financial obligation as they come due, right? So without incurring unacceptable losses. And we'll see an example of this as well. But what it basically states is you do not have sufficient money when you need money, right? And if you have to somehow manage to get that money, then you have to incur unacceptable losses. So that is the definition of liquidity risk, that you do not have the money when you need it, right? So this is probably what you probably need to remember, which would be the maybe the third point in this presentation that you need to remember. Moving on. So there are different types of liquidity risk, but the two are more prominent, and that is where we should focus on, because other, as I mentioned, are just different versions or different variations of this. So the first type of liquidity risk is called funding liquidity risk, and this is probably the example that I also gave at the start of this presentation, that you need to raise cash, right? Now, if you have a bad credit score, you might struggle to raise cash, right? So that is the definition of funding liquidity risk. When you want to raise cash, when you want money for something, but you are not able to generate cash because of your profile. And once again, why a bank would not like to give you cash, right? Because your credit profile is bad. So once again, you can see the risk is changing, right? The credit risk is getting converted into liquidity risk. Earlier, we have seen the example of where liquidity risk get converted to credit risk. So you can see this transition happening at different points of time. So this is one particular example which maybe all of us are kind of familiar with. We just now attached a name to that, which is called funding liquidity risk, which is basically raising cash from the market. Other type of liquidity risk that we may not be that familiar with is called transaction liquidity risk, which is when we need money, but we will not be able to sell an asset at fair price. Now, whenever you are selling asset, there will be two prices. One would be the price at which you want to sell the asset, the price at which the seller wants to buy the buyer wants to buy the asset, right? So these are denoted by bid price and offer price. Now, I don't want to go into detail of what is bid price and offer price. I believe you already have the knowledge for that, right? But and the difference between these two, bid and offer, as you can see in this screenshot, right? So this happens when you are in an illiquid instrument, or if there is panic in the market, as for example during the 2008 market crash, when everyone was trying to sell their portfolio, and because of that there was no buyer in the market. Because there was no buyer in the market, so there is only offer price, there is no bid price, right? So there was no liquidity, and that caused the portfolio value to erode further, and that caused further panic and then trigger further sell, and then there was no buyer in the market at all, right? So in such a situation there can be a huge amount of transaction based liquidity risk when you are trying to sell something just so that you can realize profit or you can minimize your loss, whatever may be the case, but you are not able to do so because there is some difference, right? And sometimes you will be able to sell, but at a price which would be very, very different, right? Which would be very, very different from your intended price. Something we call slippage. If you are into trading and if you are into you know stock market, then we call that slippage, because there would be it mainly happens with illiquid instruments, right? So these are the two types of liquidity risk that we need to remember, that is funding liquidity risk and transaction liquidity risk. And along the course of this presentation, I've already seen how the risks are transcending. Moving on. So as I mentioned, an example of trading. So there is, this particular type of trading which happens, and it is very popular throughout the world. There are multiple hedge funds and there are multiple trading houses, proprietary trading houses who uses this form of trading, which is called high frequency trading. That solely depends on the number of buyers and sellers. So basically, if I go back to the previous slide, and if you see this number of buyers in this case is 745, and number of seller in this case is 964. Now here you can only see 5 or 6 data points, right? Suppose you can see 5 lakhs data point, right? For which it is not available to general public, for which you have to pay money to the exchanges and to other, you know, parties in the stock market. But if you can have the data, so then this quantity would represent the frequency, right? So you have 5 lakh data and you are seeing that at different points, this what are the people that are, and what is the quantity that is being bought, or that for which the order is placed. At the same time, you are also seeing what are the quantities for which the sell order is placed, right? And you are seeing that there is a massive difference between this and this, right? So you know that right now, if the sell quantity is higher, then this instrument price is going to go down. And you also know at what point that price would be like a higher sell off would be triggered, because you can see those data points. So that is called high frequency trading. Depending on that data, depending on the frequency, which in this case is the quantity, you are depending on the liquidity, right? Your assumption is for that instrument you will have good liquidity, because if you do not have good liquidity, you will enter the market, you will not be able to exit, right? So high frequency trading is a very short term or short form of trading where you just enter the market, stay there for maybe a couple of seconds and then exit. So that is where you enter with a huge amount of quantity, maybe 1 lakh, 1 crore, huge volume of quantity. You just capture maybe 2 cents or 3 cents and get out of the market. But once again, your underlying assumption here is the instrument has to be liquid, because if the instrument is not liquid, then you will struggle to exit. And if you struggle to exit, then the price might move against you, and because you are in a very high volume, then that would cause tremendous problem, right? So this high comes from the volume, and frequency comes from the number of buyers and sellers. So that is a example of liquidity based, or if you understand what liquidity is, so you can use that to your leverage, and you can make some money in the market. Obviously this is something that requires a lot of technical expertise, and it cannot be done by normal people like you and me. It has to be done through an institution. You would require some software, something called co-liquidation, and multiple other things, so that you can carry out the study. And like I mentioned, this has very high transaction cost if there is illiquidity. So then you probably want to purchase it at 100 and sell it at 100.25, right? So that 25 is very important for you, because you are entering with maybe 1 lakh quantity. And if somehow there is no order at, or there is no liquidity at 100.25, then you will not be able to sell it at that point of time, right? So maybe it get executed at, maybe at 0.95, because from 100 it got uh, below 2.95. So in that case, you have to incur a huge loss, right? So that is where it is very important that whenever you are doing this form of trading, just based on the concept of pure liquidity, then it has to be a very liquid instruments. Moving on. So these are the types of liquidity management, right? And mainly predominant types. There might be other types of liquidity management as well, but mostly these are the types of liquidity management. First is raising capital. We have already seen an example. Then second is estimating daily liquidity. Like what would be your daily criteria? Mostly prevalent in banks, because liquidity management is more required for banks as compared to an insurer or maybe other other companies. Also for trading companies like proprietary trading, hedge funds, the example that I was giving, they also need liquidity because they trade in huge volumes. And sometime if they do not have liquidity, it might trigger margin call. So that is why liquidity management is very, very important, and you need to manage your risk so that you can estimate your daily liquidity. And this is where I think actuaries can play a good role. Something that actuaries are already doing right now today, that is asset liability management, required for banks, more significant for banks, slightly less significant, but even in insurance as well, we are doing this. Asset liability management is quite important, right? And then other thing which is very important is governance and audit. So these are very complex things. It has to be governed. There has to be, some predefined procedures and SOPs which has to be uh, maintained and audited, right? There also actuaries can play significant role because actuaries has the expertise or the domain knowledge to create all of this, and they need to ensure that the process has been followed. Slowly and steadily, we are going to look at this, all this food and how actually can play a part, right? But this is the first pause that I'm going to take and see if there is any question till now.
No, Arpan, we have no questions as of now. You may continue. Yeah.
Sure. Okay. Thank you, Krishna. So moving on, liquidity management with respect to banks. Now, how liquidity management is very important. As I mentioned, liquidity management is very important for banks, more important than insurance. And here, banks operate in a different model, right? For banks, the loan are their asset. For any other company in the world, loans are liability. But for banks, loans are their asset, and the loans are usually long term, for longer duration. You will take a loan for 20 years, 25 years, 30 years maybe, right? So loans are for longer duration, and banks are financing those long term asset, right, with savings which are short term. Saving is just like you and me putting the money in the banks, so that and the banks are not holding that money, right? So bank will put a fraction of that, and keep a fraction of that, and lend the remaining portion of the money, right? And that would be given as long-term loan, right? So here a short-term financing is done for a long-term asset, and which is where liquidity management is very, very important, because your saving or because your liability or your source of fund is short-term. One day, a person can come and if that person is a high net worth individual, then that person can draw money from the bank, and that can put tremendous pressure on the bank to manage its daily liquidity, right? So that is why it is written daily withdrawals put tremendous pressure on the banks if the withdrawal is huge, especially something that we are going to study later on in this presentation, which we call bank run. Bank run means everyone is running away from the bank, right? So everyone is withdrawing money from the bank. Especially happens when there is a bad news about the bank, or there is some news of scam or something to do with the economy. Maybe the economy is not doing well. So in that case, the withdrawal limit might exceed, right? And that is where we have to understand what could be the maximum loss, or what could be the maximum liquidity need for a bank in such stress scenario, so that we can you know uh, manage the liquidity for the bank. Third thing in this case would be the repo transaction or other money market instruments. So repo or the money market are dominated by banks. Money market are basically instruments, financial instruments, which are for very short term. Usually they cannot be over 1 year duration, and repo is very small. They are usually for, maybe there is overnight repo as well. There is 90 days, maybe 6 months of repo, right? So repo means if a bank has excess an excess fund, then the bank can give that as a loan to any other bank who is in need of liquidity. But then for that, the other bank has to deposit some good quality instruments with the bank, right? So that is what we call. I don't want to get into too much detail of repo because this presentation is not on that. But repo management is also a very complex process. There are teams looking into the repo management, because this is the main way a bank is kind of managing their liquidity risk, right? So the bank would lend money to the other bank, and there are different rates. The rates are also changing. Like we have the rate for Libor, right? These rates will not be used in future, but we used to have those rates, Libor and then Mibor, and there are multiple rates like that. Based on who is the report rate would be determined, right? And then the banks also participate in structured derivative products or swaps. Structured derivative means these are specially created derivatives for particular people and use, or maybe for big institutions, right? So these are not exchange traded derivatives where you and I can participate. These are specially created derivatives. And once again, those structured derivatives or swap might have their own liquidity requirements, right? So for example, suppose you are in a swap, right? And at some time you are receiving fixed rate, and you are giving them a floating rate. So in that case, sometime the floating rate might increase, because of some reason, and then you have to give more than what you are receiving, right? So in that case, there would rise an urgent liquidity need for the bank. So as you can see, based on this discussion, you can easily understand that liquidity management is a very complex thing in bank and probably has the most application in banks. So if as an actuary, if you do not want to work in the insurance domain and if you want to work in banks, probably this would be the field that you will be working on, because this has a lot of challenges, and whenever there is challenge and whenever there is risk, right, there is a lot of opportunities for us, right? So this is one place where we can work and add a lot of value to the banking system, which is not the case in the world right now, but we have to make that happen. So I think one point we can take from this is the banks are in need for frequent liquidity, uh, like frequent liquidity, like every day banks are struggling to keep liquidity or maybe using proper amount of liquidity, right? So that is why liquidity management is bank is extremely complex, right? Moving on. So liquidity management for insurer, uh, this probably most of us will be familiar with because we are actual students, so we already know. And that is why it is slightly simpler than banks. These are mainly salary and wages, which are our day-to-day requirement, or maybe we have to pay those monthly, right? Then surrenders, if you are in life insurance, then surrenders can happen at any point of time, and that can a big surrender can create a liquidity issue, right? So there are regular expenses, and of course asset liability management, which is kind of similar to the bank. There might be some margin call related to some derivatives, but because of the regulations for the insurer being very prudent, usually much more prudent than for the banks, so that because of that reason, usually insurer do not suffer too much from the asset liability management, because they do not have the ability to say purchase a structured product, because they are not allowed by regulation to do so. They cannot maybe trade a derivative, or they can only use derivative for hedging purpose, but they cannot use it for speculative purpose. Then that is where the liquidity management for the insurer is not that tough as compared to a bank, which is in need of regular liquidity management. Moving on. And then, as I mentioned, something that we are also kind of trying to catch hold of is derivatives, right? And this is where derivatives liquidity management is usually done to central clearing party. Now, what we have to understand, what do you mean by a central clearing party, right? So central clearing party is a party which is buyer to all sellers and seller to all buyers. So basically, it is a middleman between a buyer and a seller. So when you are buying it from the central clearing party. You are not buying it directly from the seller, right? That happens in a different type of market. I'm going to come to that. But if you are trading, or if you are investing through an exchange, which most of us do, then you are buying from a central clearing party, and you are also selling to a central clearing party, and the gap between these two, that bid offer spread, right? The gap between these two, at what price the central clearing party is buying it and what price the central clearing party is selling, that becomes the profit for central clearing party. So the basic role of central clearing party is to provide liquidity, right? So that is where derivatives, and especially for derivatives which are highly leveraged instruments, like there is, by leveraged, I mean that you can, derivatives can give you more exposure than it is happening on paper. So that is why derivatives are highly leveraged and highly risky at the same time. So in such cases, as for example, if you have bought a future, right, and futures are mark to market settled. So every day, whether you are in profit or loss, that amount will be deducted from your account. If you are in profit, then that amount will be deducted it will be added to your account. And if you are in loss, that amount will be deducted, right? So this entire thing would be done by central clearing parties. Usually, these days, central clearing parties are the exchanges have their own central clearing parties. So they usually would be the fully owned subsidiary of the exchanges. As for example, since I belong to India, in India there are two exchanges, NSE and BSE. So NSE have their own central clearing party, which is a fully owned subsidiary of NSE. Similarly, there is a fully owned subsidiary of BSE as well. Once again, their main job is to provide liquidity so that other people can trade in the market. And then we come to the other type of market which are not exchange traded. So these are over the counter market or OTC market. And this is where buyer directly buys from a seller. There is no central party, right? So in this case, you have to deposit some margin, which is kind of similar to how we keep reserve. So because you can run away, right? As a buyer, you can run away if you are not able to, give uh, the your portion of the liquidity. Similarly, same can happen for a seller at the time of maybe providing the instrument. The seller can run away, right? So because there is no legalized or authorized or formal structure in this case, so in that case you have to deposit some margin so that if something like that happens, then you are, the buyer has some access or the seller has some access to the other capital, and that margin would be used to kind of lower the risk, right? So this is usually governed by some agreements which we call ISDN, that stands for International Swap and Derivatives Network, or something like that. So that has some rules for over the counter market, what amount of margins has to be deposited, in what form the margin has to be deposited, who will handle the margin, right? And can the margin be traded, right? So there are two types of margin: initial margin and variation margin. How the initial margin is determined. So all these are kind of determined by this body called ISDN. There are rules and regulation for that, and because there are rules and regulation, there is less chance for judgment. And because there is less chance for judgment, actuaries have lower applicability there, because actuaries are required where there is something had to be estimated, something can go wrong, there is scope for judgment, right? But because in this case it is rules driven, right? There are written rules that you have to follow this, right? So that is where actuaries have limited applicability. So these are much more simpler. So banks, the liquidity management is much more complex as compared to, it gets slightly simpler in insurer. And if we go to the stock market or derivatives, right, which is where the main liquidity risk arises. So there it is much more simpler. However, there is a chance, once again, the risk is transcending here into something we call systemic risk. Systemic risk means the entire economy or the entire stock market economy can collapse. And that can happen if the central clearing party is collapsing. So suppose the central clearing party, for some reason, is not able to, kind of has bought some instruments but is not able to sell it, right? So now the central party is looking for liquidity, and unfortunately, clearing party is not able to get people in the market to whom they can sell, right? So then they are carrying a lot of inventory, or maybe the central clearing party has sold is forced to sell, but at a huge loss because there is no buyer at a particular price in which the central clearing party wants to sell, right? So in that case, the central clearing party can incur severe loss. And because central clearing party is such an integral part of the market, if the central clearing party goes bankrupt, everything in the market can go bankrupt. Right? So that is a systemic risk associated, especially it is, this type of risk happens in derivatives market, right? A recent example of that was when the Credit Suisse bank, that was not working well, that was kind of on the verge of collapse, and then it was merged with another bank. But then people have purchased something called credit default swap, and so the credit defaults of the central clearing party, for that they were not able to kind of sell it off, and then there was some systemic risk being triggered. But the regulator was smart enough, so they were able to handle that, right? But if something happens to the central clearing party, then it can trigger a systemic risk, which is something that we need to remember from this. And that can trigger financial collapse for the entire country or maybe worldwide. And this is something, once again, the liquidity risk is transcending into a much bigger risk, right? Moving on. So as I mentioned, derivative risk. Now, how you are managing the collateral or the margins that you are keeping, that can lead to credit risk. Like I mentioned, there will be two types of margin: initial margin and variation margin. So these are kept with both the counterparties, like counterparty A, counterparty B, who are in the OTC market. And for them, if the other party is not willing to pay, right, so then that can change into a credit risk, which is another example where one risk is getting converted into other risk. And as I mentioned, there are rules and regulations which are governed by that ISDA body, and then ISDN will kind of maintain and try to have uh, proper rules and regulation in place and audit those at relevant intervals so that such things do not happen. But it does lead to credit risk, right? And I think that is evident how it can lead to credit risk. So how we can do liquidity risk management, and the moment you understand this, we also understand what role actuaries can play, right? And as I mentioned, like as a company, we are also trying to get into this domains, and you have already got into a bit of these domains. So that is where we are also seeing the opportunity, right, in the market. So first is your early warning indicators. So it's very simple. You have multiple ratios, debt ratio, liquidity coverage ratio. There are multiple ratios, and if those if those ratios are indicating something is going to happen or something bad is approaching, then that might happen, and then those can serve as early warning indicators. Also, if you are seeing similar banks collapsing or something happening in an economy in a different country, that same situation can be replicated in your country, so that leads to caution, and one need to be caution about that. So that is where once again uh, these are areas which are mostly handled by accounts team or uh, some domain experts which are who are usually not actually. So once again, there is limited role because these are formula driven things. And once again, whenever something is formula driven, rule driven, right? So then that has limited role for actuaries. This area is mostly dominated by accountants and economists. So that is where people like us who are actuaries have limited role in this, because you will see that the warning indicators are kind of usually they are flagged by economist, right? So that is where we usually have slightly limited role in this. Moving on now.
Arpan, just
Yes.
we have a question from Lashita.
Okay.
So she has a question on the role that
Mhm.
since banking and credit risk roles for actuaries are still limited, how
Mhm.
does the role of a banking actuary differ from that of an FRM?
Yeah, so I think so great question first of all. But actuaries are they deal with mostly they deal with capital and reserve, like, and we are going to see a portion of that in the later part of the slide. But FRM people, they usually deal with financial instruments, like if there is a say a market related risk, they will purchase an instrument and uh, to hedge that, right? So I think for us, we try to manage the risk, actually try to manage the risk more internally. Like we do not want the risk to happen. And if there is risk happen, that risk happening, then we have money to take care of that risk. As compared to, FRM person or someone who is from a different domain, that person will try to buy instrument or try to do something with the money at that point of time. However, there is like there is a lot of what can I say? There is a lot of similar areas, right? And right now, based on the syllabus that we have, probably an FRM person is much more closer to this sort of risk, like liquidity and credit, as compared to actuaries, because our maybe books and our materials are probably designed for more more prevalent or more better suited for the insurance kind of risk. But yeah, I mean, that is what this presentation is all about, that we can slightly tweak those knowledge, and we can move into that domain. I hope that answers. Okay, so moving on. Next is liquidity stress testing and stochastic stress test. So these are things that banks has to do, and it is devised by Basel. Basel is the body like our Solvency II, which is where they try to understand and define how the risk can be captured right? Especially in stress situations, bad economic scenario, right? And this is where I think actuaries can play a lot of part, right? And play a lot of important roles. For us, we have also have different products which are kind of like saving product. As for example, a product which guarantee return. Say for example, there are multiple universal life product or variable universal life product or variable funds where there is a guarantee, especially in the western part of the world, like 4% guarantee, 6% guarantee, right? And actuaries have to reserve for that. And in 2008 or in other crises when the market collapsed, right? So then this guarantee started to bite. But then we already have a method for which we call cost of guarantees, which are added to the reserve, which is based on the stochastic process and method, right? So our actual softwares can also do this sort of calculation, which is calculation for the cost of guarantee. And same thing can be done for banks. In fact, for bank, it is much more easier because our softwares or an actual software is programmed to generate this over a long period of time. For banks, it will be much shorter. The time frame will be much shorter. So actuaries are very well versed in handling such situation and doing stress testing, especially for the structured derivative products and the liquidity management for the banks in the stress scenario. So we have a lot of applications in this domain, and this is something that we can dominate because we already have the background for this. Moving on, something that is very important, which is where actuaries also add a lot of value, is value at risk and expected shortfall. Basically, it means tail risk, and this is a risk measurement measure, like the question that was asked, like how is FRM and actuaries different? So actuaries differ in this way that they try to keep capital uh, at the start before the risk has happened, and FRM would usually work when the risk has happened, and then they try to handle that, right? So actuaries will try to keep a certain amount of capital. What will happen when in 99% of the scenario that capital will be sufficient, right? So that value is what we call value at risk, which is kind of denoted here by this this dotted line, right? So this means that this is a tail situation. Like this is very limited situation, that there will be very rare scenarios like this. But when some situation like that happens, you have sufficient money, right? And something similar to that concept is what we call expected shortfall, which is the average of this tail, right? So basically, if you have that amount of money, then you will be able to handle maybe even bigger risk, right? So once again, I don't want to get into details of these two concept, but we just need to understand that it relates to tail risk. And tail risk means that because it is in the tail, the frequency of that event happening is very rare, right? It's maybe 1 in 1,000 kind of scenario, but it can happen. And if it happens, it can cause tremendous damage, right? So for that, there is only one way we can handle that, is to keep capital, which actuaries are doing. Like a parallel for the actuaries would be solvency capital, or also better known as economic capital, risk-based capital. There are several names for the same thing, and we can do the same for banks. But once again, the challenge here is for bank, the liquidity crisis can happen much more frequently as compared to an insurance company, right? So here the value at risk has to be more volatile, right? It has to be maybe adjusted to a much shorter time frame as compared to a much bigger time frame in which we usually operate, right? But once again, actuaries can add a lot of value because they're already doing something similar to that in the insurance domain. And if you ask me, then this is the domain that we are trying to capture in bank, that we already have this expertise, we can do this for you, and we can capture this domain. Moving on. And finally, the contingency funding, which we are already aware of, which is reserve. Once again, based on similar concept, based on what can be the probability of a liquidity crisis and how much money is required, right? We can keep certain degree of reserve, which the banks are also doing, right? So the banks also have their own way to keep calculate reserve, and that is also something conceptually which is very, very similar to the actuaries, right? And that is where they can add a lot of value. Okay, moving on. So I'm just cognizant of the time, so I'm moving slightly, slower. So I'll just try to finish it rather than asking a question. So yeah, so coming to the liquidity risk management, then the second thing, the final thing is collateral management, which is mainly used for derivatives, especially for the over-the-counter derivatives, where you need to, kind of keep certain amount of collateral so that the risk does not uh, goes out of hand, right? One second, here actuaries have limited use because it is rules driven. It is very difficult to get into this domain because everything is kind of formalized and rules driven, right? So if you if you remember what how liquidity risk is happening, then we can see that for stress testing, actuaries have certain advantage there, and also for calculating the VAR and expected shortfall, because these are the measures that are used for liquidity risk, and actuaries can add value there, right? So that is where liquidity risk management probably would come to an end. But we are going to end this with a story, which is of the SBB bank collapse, right? So for SBB banks, and now we are going to relate to every concept that we have studied till now. So SBB bank, the customers are mainly startups, and we know the startups thrive in bullish environment when the market is going up, right? So then everybody has good money and they can purchase from them. So the customers are more, majorly startup, and they grew at a rapid pace. They took loans from the market, right? And that is when there was a change in the regime because of the inflation. So the Fed banks and the central bank had to move from a low interest regime to a they tried, they raised the interest rate, right? So earlier the interest rate was very less, so everyone was getting loan at a very cheaper rate. But then when the interest rate was risen, then they were not able to get the loan, right? So in order to get access to the money, they started withdrawing from the bank, because now the loans are not that cheap, right? So they started withdrawing from the bank, which created the liquidity crisis for the SBB bank, which is a very well-known case study. And then that lead to collapse, right? And which is this is what we call bank run. Everyone is running away from the bank. Now if there is bad news on the market, right, then you will also try to withdraw your money because there is some prevalent bad news, and that is where the collapse was triggered, right? So then there was a body in US which is called FDIC, which is basically an insurer. So they guaranteed that everyone would get their money, right? So they introduced this program called bank term funding, right? So based on that, so they assured that everyone will get their money, and that is where they prevented the collapse, which was a systemic risk. But they, because of this smartness, they were able to close that. So which is where I believe that actuaries could have prevented this from happening, because there was a lot of triggers like that. And if actuaries would be part of the banking system, so then they would have captured that in stress test, or they would have captured that in the VAR, right? And because these banks are growing at a rapid pace, so few of the regulations that was required to be maintained for a big bank was not applicable for them, because at that point of time they were not considered that big. But then within couple of months they grew to a big size, right? So this is where also actuaries could contribute a lot, based on how they can perceive the bank, because we have the financial awareness, which is kind of coupled with economics and other areas of finance as well, right? So this is an example where we can see the bank run has caused a liquidity crisis. Now we are going to move into the credit risk, and credit risk is something which is the loss that arises from when a borrower is not able to meet their contractual financial obligations. We have already studied a bit of credit risk, like in the collateral. If a person is not able to maintain their portion of the collateral, then that might trigger a credit risk, right? So this happens in derivatives, over the counter derivatives, especially. So these are the types of credit risk. Like we have studied the different types of liquidity risk. So first is default risk that the borrower will not pay, right? Some example how it can be managed is CIBIL score. So in India, it is a credit score, right? So in different parts of the world, there are different names given to this score. In India, it is called CIBIL. So if your CIBIL score is bad, you will probably struggle to get a loan, right? And then there are also credit rating companies who will give institution rating. The company that I work for also give rating to different companies like AAA, double B, triple B. The credit ratings are even given to countries like India and US. So they all have their own rating, right? So this is how we try to understand what would be the default risk of an individual or of an institution. Second is counterparty risk, something that the other party is not willing to pay, right? This happens in derivatives trading as well. Another example is reinsurer, right? So if the insurer has passed on their liability to the reinsurer and the reinsurer is not willing to pay, or reinsurer do not have the mean to pay, right? So then that is also a counterparty risk, which is also a risk getting transcended into another type of risk, like the insurance risk or mortality risk or lapse risk, whatever you can call it, right? So you are passing on that risk to the reinsurer, and that risk is getting transferred or changed into a counterparty risk, which is another example of risk changing. Then obviously there is concentration risk. If you are giving loan, like in the case of SBB Bank, right? So they have only given loan majorly that is to startups. Had they diversified their portfolio, such sort of bank run would never happen, right? So that is where concentration risk plays an important role. So credit risk management here, usually for individual KYC is done, that is know your customer. For institution, due diligence. Derivatives, we have already spoken about this. Credit default swap, it is based on the concept of insurance. This is a derivative instrument, but it's based on the concept of insurance. Like if someone defaults, then only this instrument is going to pay, right? And if the person is not defaulting, then you have to pay a premium for that. So it is based on the concept of insurance. So that is derivatives, and we have already gone through over the counter derivatives. There are multiple ways credit risk can be managed. One of the ways is netting. Netting means whatever is the the counterparty exposure, you can add that. Suppose counterparty A has to give maybe $1,000 to counterparty B, and he is also going to receive $500 from counterparty C. So if the counterparty A defaults, then those would be added, and ultimately its exposure will be 500, right? So that only happens when there is a central counterparty. Other than that, it is very difficult to do. So over the counter derivatives, netting is an important way to manage the credit risk, right? But here, if you carefully see that all this do not require judgment, right? So that is where credit risk actually is a very limited application, right? As compared to the liquidity risk. And of course, there is credit value at risk, which is similar concept, but it is only applicable for the credit risk segment. So we can actually participate in once again calculation of where whenever there is a mathematical concept which requires a lot of judgment, right? Which would be the right zone? What is those extreme scenarios? Whenever you are judging something, then actuaries have opportunities, right? However, as I mentioned, rest are kind of rules driven. You cannot change KYC. KYC is basically like an underwriting, right? So that is rules driven. Similarly, the rating agencies have taken over the ratings that will be given to the institutions, rules driven. So there we see limited, use for actuaries, or limited application of for actuarial principles. However, in mathematical calculation like CVAR, actuaries have a role, and actuaries can determine something which is very important for credit risk, like expected loss, which is dependent on this formula. And in this formula, this probability of default, this requires a lot of judgment. Exposure of default, right? Exposure at default, this requires a lot of judgment, right? So actuaries can play important role. So whenever it is related to setting aside some money for something related to future, actuaries can play a role. And that is where we need to enter into this. That is what we need to kind of put in our CV to enter into this domain. Similarly, for unexpected loss, it is slightly different. The formula is slightly different, but this concept is similar to economic capital, and which we have already discussed. So I'm not going into detail of that, but this once again means the loss that is in the tail, that can happen very rarely, but once it happens, it can leave a tremendous damage. So finally, I'll just close this. I just see that there are very less time left. So I just wanted to close this with a combination of liquid and credit risk. so that we have some time for the questions, right? So something we call securitization. Securitization means that you take illiquid asset from your balance sheet, like banks, especially it is done by banks. So something like loans, home loan, commercial loan, they will, they will convert that into an asset. So those may be illiquid asset, right? Maybe some people may not pay. So that is why those might be liquid. So now the bank will create an instrument and will the purchase or the buyer of that instrument will get the interest as well as the principal payment, right? Depends on the the type of the instrument, and that is where the liquidity risk is changed into credit risk. Now, as a buyer, if the other person is not paying, like those who are the customers of bank, if they are not paying, then that is a credit risk for you. However, the bank is very happy because the bank has removed the illiquid asset from their balance sheet, and then they have converted into an instrument and got money for that, right? So this is an example where illiquid asset from the balance sheet of the bank is being converted into credit risk. This is another area that my company is working to, and actuaries would be hired in this. There are especially three tranches usually: senior, mezzanine, and equity. So equity would be the first block to hit the to have the losses. If equity is exhausted, then mezzanine block or mezzanine tranche will have the losses, and finally senior. So that is how it is. And there is something called over collateralization trigger. So when you, in good times, when you have more interest, more money flow that is flowing in, right? You want to keep something so that you can pay at a later point of time, right? So once again, that depends on judgment, and actuaries can add tremendous amount of value. So this is something that is done throughout the world. This was very prevalent before 2008. After 2008, there was some problems, and that is where this is not that frequent now. But once again, this can be actuaries can add a lot of value in this case. And of course, so with that, I come to the end of it. It took slightly more time, but yeah, ready for any questions.
Yeah, no worries, Arpan. Thank you so much for this insightful presentation. You covered a lot of areas which I think are very niche, and especially the SVB case study and the link between liquidity and credit risk. So that was wonderful. I would request all the participants, all the attendees to please put your questions down. We already have few in line. So let me start with first question. What are the typical ways to optimize an insurer's liquidity position?
Insurers liquidity position. So insurer usually keep capitals for liquidity position. So they do working capital management, right? So they invest in securities like cash, which can be easily liquidated. But there is no as such optimization mechanism. It has to be done, over a period of time, depending on how the insurer is experienced for a particular insurer, right? So that is how it works out.
Great, great. Thank you, Arpan. Before we move ahead with the another question, we have a QR code for the feedback for this webinar. So everyone, please put your feedback. Nikki, I would request you to put the QR code on the screen so everyone can put their feedback. Another question is, if I understand correctly, the VAR indicator suggests how much cash we need under a stressed scenario. Say if VAR suggests 2% cash shortfall,
Mhm.
and how does this affect the solvency capital and solvency ratio?
Okay, so whenever we are talking about solvency, we are talking about an insurer, right? Because for bank it will be risk-based capital. But if you are the basic concept of solvency capital is it is to be used when there is a tail risk, right? So whenever there is like a situation like COVID has occurred where multiple people might be facing death and there will be huge mortality risk. So in such situation, you will expect that your capital solvency capital is big enough to handle that risk, right? In case it is not big enough, which is probably the what the question is asking. If the solvency capital itself is not big enough, then the shareholder has to pay the money. If the shareholder or the bondholder, they do not have the money, and then the next step would be for the company to raise capital from the market. Now, suppose the economy is such that the company cannot raise capital from the market. In such case, the company has to file for bankruptcy. Usually, what happens in banking and insurance sector, it will be merged with any other bank, right? So that is how it happens. Solvency capital is like your last ability to fight a big crisis. If it does not happen, then it goes to the shareholder, and from there it can rapidly turn bad for the company, right? So we should pray that a company is not exhausting the solvency capital. If it happens in that, like in the question, if it is 20% below solvency capital, then probably it's not going to survive.
Great. Hope this answers the question. We have another one. Can netting apply to exposures from different CCPs or have to within the same CCPs? Is gross exposure measurement still important?
No, it does not apply to different CCP. Netting applies to only one CCP. So just to give an example, suppose you are trading in, say, National Stock Exchange of India, NSE, and then there is only one CCP that applies there. So it will, apply only on that CCP. Now, sometime it might happen that the regulator might force different CCPs to collaborate because of a systemic risk, right? But that is not an usual circumstance. So in such situation, it might happen that a different CCP might be called in to put money, but other than that, it is only prevalent for a single CCP.
Great, great. Another we have from Lashita again. Building on the SVB case study, what
Mhm.
role can actuaries play in central banks and uncertainties arising from geopolitical disturbances to manage the global banking system?
Yeah, so I think actuaries has to see the risk before it is arising. So first of all, you need familiarity with domain. So whenever I give presentation to banks, so where actuaries can actually play a part uh, in managing the risk. The basic challenge that I face is most of the people who are working at a senior position in bank, they have not heard about actuaries. They are not familiar with the work that we are doing, right? So first is we need to show that we have domain expertise here in this case. So if an actuary is working in central bank, so in central bank mainly works in two policies. One is monetary policy, another is fiscal policy. Monetary policy is handling the inflation, fiscal policy is handling the debt for the country. So actuaries need to have tremendous knowledge on this, right? What can increase the inflation, what can decrease the debt. And once actuaries has that, so the actuaries can assess the risk of that domain and keep capital aside, right? Or devise how, if something like that happen, if a tail event happens, then what would be the possible ways the bank can generate liquidity or bank can have access to cash, right? Like in the example of the SVP bank collapse, FDIC created something called Banking Fund Trust, which was a temporary fund that was created where any bank which is facing liquidity crunch, they can draw money, and it was created on a temporary basis. So this is something like there can be a trigger for something like that. Actuaries can devise those trigger, like if in this condition, this is the amount of capital that can be kept aside, for which the bank has to give contribution beforehand. Like, so we can replicate the entire concept of insurance, like paying premium upfront so that we have a capital that can be used by the banks at the time of crisis, right? So this is exactly what I know. I pitch to the banking companies. Like I just gave you my trade secret. So that is how you can handle economic crisis, geopolitical crisis. And I think actuaries are going to be employed in this sector very, very soon.
Yes, yes, I agree with you, Arpan. Next, we have from Bimala. When do you think the insurance sector in India will feel the need to hire credit risk modeling actuaries for capital needs? Like, what do you
So
predict?
right. So, if you ask my opinion, honestly, I don't think insurance sector need that, because as I mentioned, insurance credit risk is something that is mostly related to the financial instruments. By default, the regulation is such, especially in India, the IRDA regulation is, for the lack of better word, is so prudent, that you will not be able to invest in different sort. Even in equities, you will struggle to invest in different types of equity. As an insurer, you may not be able to invest in a mid cap, equity. So such sort of credit risk does not arise. It is not a significant risk for the insurer. The only credit risk that arise is the counterparty risk associated with the reinsurer, which is where the credit rating agencies comes into picture and they give rating. So I don't think insurer in particular have need for credit analyst, if you ask me.
Okay, understood. Thank you, Arpan. Now this was the last question. We have one more. Do you think IRDAI will move to internal model framework for solvency relative to the standard formula currently used? This will create
Yes.
demand for other modeling actuaries. Would this create?
Yeah, of course. IRDA would be forced to move into that, and I think they are moving into it. So in Indian sector, IFRS 17 will be implemented. I don't remember the date, but some date in 2026. So right now, the capital is based on factor-based method. It's just to give a simple example. Suppose your reserve is $100. Factor-based method means you multiply a factor with that. So 100 into 3 would be 300 would be your capital as per the current regime of IRDA. But because of moving into IFRS 17, your reserving will be based on best estimate method. In best estimate method, your reserve can be negative. So right now our reserve is calculated on prudent basis, which has to be positive. But in best estimate method, reserve can be negative. Now you cannot have a multiple of negative reserve. So if your reserve is minus 100, you cannot say it is minus 300 is capital. Then that means you need not keep capital, right? So because of moving into IFRS 17, whenever you move into a market consistent regime, IRDA forcefully has to move into risk-based capital, right? So that is where and risk-based, whenever you move into risk-based capital, I believe initially they will have standard approach, right? So they will give the whatever risk and whatever stress you have to apply, but later on, depending on the size of the different insurers in Indian market, there are only three predominant insurers. Rest are maybe not doing that well. So internal model will be very, very important, which is where a lot of big four companies are also vying for getting that consultancy. So that is going to happen. You will probably see something like that happening in end of 2026 or 27. That is definitely going to happen.
Okay. Great. Hope I have covered all the questions, everyone. So, with this, we will end our session and thank Arpan for sharing your expertise and valuable perspective today. I also want to thank all of you participants to, make time for this webinar. It is very important for us to have this engagement. And please don't forget to put your feedback. So we will bring such very interesting webinars henceforward as well. Thank you and wishing you all the very great day ahead. Bye.
Bye. Bye, everyone.